Welcome everybody. We're letting people just file in right now. So looks like
we got the rate decision. It's exactly what we thought, 75 basis points.
Oh, did they just announced it?
Yeah.
Okay. Yep, that's what we were expecting. That's breaking news for everybody. Right there. The Fed just announced that they're going to raise the interest rates, the Fed funds rates, 0.75%, so 75 basis points this month. So that's breaking news. So for all of us nerds, that's really exciting. Watching this, always going, okay, what are they going to do? Is the Fed going to be hawkish? Are they going to be more dovish? What's going to happen? So it'll be interesting also to actually watch the actual press conference and try to glean some thoughts from it.
There'll be lots of parsing of little words and nuances and so forth.
There always is. We're always watching and say, now he said it like this. What does that really mean now? You know, right. As we're out there trying to make decisions on everything. So looks like you got a bunch of people that have already logged in. I know we have a number of people here in Utah, but we have actually a number of people, clients from across the country. And then I even have a couple from out of the country that have joined us. So we'll be talking about US bonds, not international bonds, but a lot of the principles we'll talk about today will just hold true. I think let's jump into it. Couple other quick things coming up. Right now we have the election this next Tuesday, so that'll be interesting watching that and see how that affects the markets. Obviously the Fed minutes, watching those today and seeing what they have to say, and then also we'll watch them again this next month and going into this next year. Today we're really fortunate to have Monica Sonnier with us. I've known Monica for a number of years. She's been doing bonds for over 30 years now. So yes. Very
I started when I was 12. So.
Yes, maybe 2 even. You look like you're 32. She was the chief investment officer for a banker's bank. So that's a big deal doing that. She's managed billions of dollars over in bonds, and we're really fortunate to have her. So I'll turn it over to you, Monica, and let you just kind of talk about the basics of bonds, and also everybody, you have a spot where it says Q&A. Feel free, submit any questions that you have there, and I'll read those questions and we can ask Monica her take on each of those questions. So yeah, we'll do this live. And if you have questions after, we can talk about it even after also. So turn it over to you, Monica.
Okay, great. Thanks so much, Rob. Yeah, thanks so much for having me to do this today. I love doing things like this. I love talking about bonds, as Rob and I were talking earlier. So I sometimes bore lots of people to death, but I absolutely love talking about bonds. I've been doing it for 30 years and it's my passion. And so I've been really blessed and fortunate for the last about 6 or 7 years of having been able to move over into the wealth management world from the institutional side of bonds that I used to work in. And that basically just means, I only worked with banks and insurance companies and bigger investors in bonds, helping them manage their bond portfolios, which can be a somewhat impersonal world. So I'm really happy to be managing in wealth management, where I get to work with real people, and which I really love doing. So, and bringing individual bond portfolios to individual investors, it has been something I've also been pretty passionate about, because I think it's not really done that much or that well in the rest of the investment world. And when I titled this, "What are these bonds you speak of?" Because I tend to find like a lot of investors, individual investors anyway, they sort of know that the two big investment types out there are stocks and bonds, but they don't really know a whole lot about bonds or really look at individual bonds a whole lot. So I just wanted to Rob thought that you guys could benefit from just getting some of the basics about, what bonds are and what's really different about them as well in terms of, stocks versus bonds. So we'll just start real quick with what is a bond, just so we have the really basic thing there. A bond is a security that represents the debt of a company or maybe a government entity, and you're buying basically an IOU when you buy a bond from either some big corporation or maybe the federal government or some municipality. It might be a state government, a local government, what have you. But basically, whatever that entity is just promising to pay you back that money that you're lending them with some interest, and the interest is a form of a coupon, which is normally a semi-annual coupon. It can be different, but most of them are semi-annual. So as opposed to a stock investment, which, as you know, is ownership of a company. You own a little piece of a company when you buy the stock, and your return, you might get a dividend, sometimes maybe, sometimes not. But other than that dividend as an income stream, you're really just betting that the price or the value of that company is going to go up, and you're going to benefit from having an increase in the value of your investment, right? But with bonds, you could actually have an increase in just the market value of that bond and investment, which is always nice. But most people are really buying bonds just for that income stream. And we call it fixed income because generally those coupon payments are fixed at the outset. When you buy it, it's going to be 3%, 4%, whatever that coupon is. You can have floating rate instruments, although we don't see as much of those. There's not as many of those out there. More often than not, it's a fixed thing. So the bond itself just evidences a commitment by that issuer to pay you a set amount of interest, probably, every 6 months. And then at the maturity, which is always a stated maturity date, it might be a year out, 2 years out, as much as 30 years out. At that maturity date, you're going to get paid back whatever principal you purchased. So that principal is guaranteed, but it's guaranteed by the issuing entity. So you always have to think about what does that guarantee mean? Well, the guarantee, obviously, if it's the federal government, that's the strongest guarantee. But even if it's, say, an investment grade corporation, an Apple, a Walmart, someone like that, that's a pretty strong guarantee. They're very strong companies. We tend to stay with, only really strong companies there. But another benefit of having a bond versus a stock is that you're also in a secured position ahead of those stockholders. So let's say if you own the stock of Walmart, you're just a common equity owner, and you own a bond of Walmart, you're in a better position, if you will, owning that bond, because if Walmart were to go bankrupt, we don't think they would, but if that were to happen, when the assets were divvied up at the end of the day, the bondholders get paid first and the stockholders always get paid last. So that's why we call it a preferred position. But that IOU, if you will, is really what's at the core of owning a bond. Now, some people are familiar with the whole fixed income sector, if you will, more through things like mutual funds and ETFs. If you own some within, say, your IRA, you might have them in the form of mutual funds or ETFs, which is basically, pretty much the same thing as, stock mutual funds or stock ETFs, where they just buy a bunch of this security within that commingled fund, and then you buy a pro rata ownership piece of it. So the same thing for the bonds applies when you get into the mutual fund and the ETF world, that sometimes it's a good way to own the bonds. You do get some of the same benefits of fixed income ownership, like you get the income, obviously, and you do also get the lower volatility of fixed income versus stocks, which we'll talk about that in a moment. But those benefits are there when you own it in a commingled form. But it's a really different animal to own bonds within a mutual fund or ETF versus just owning those bonds outright, because some of the bigger benefits of owning bonds really is just having that bond that has a defined maturity, that ownership of something that is going to mature at a certain date. tends to give you some protection from interest rate risk, or the risk that the price of that security goes up or down as interest rates change, because you're going to get paid at a certain date. And so all those little market price volatility movements aren't going to really mean a whole lot. So you don't get that benefit though when you own a mutual fund or an ETF form, because you really just own an interest in a bunch of bonds. You don't really own a bond per se, so you don't get the benefit of that maturity. If you want to say get your money out of a mutual fund or ETF, you have to sell the shares that you own in that, and then the fund manager has to decide how he's going to raise the money to pay you off. And he might have to sell some bonds to do that, but it's going to be his choice, not yours. And if there are gains or losses, everybody in the fund has to take the gains and pay the taxes on it. If there's losses, you don't really get the benefit of those until you're actually selling your interest in that fund. So there's some down sides to owning bonds within a mutual fund or ETF format, the same way there are when you're owning stocks that way. So we always say, when you have enough money to do a real well-diversified and well-structured bond portfolio, which you really need a fairly substantial amount, probably about 250,000, which is what our minimum is for our bond strategies. Below that amount, if you really need the fixed income exposure, the mutual fund or the ETF format is an okay place to go. But if you have enough, we always recommend, own the bonds outright, because you will get all those benefits of the liquidity, the tax benefits. You can do tax loss harvesting within them if you need to. You don't get tagged with a lot of gains from a fund that aren't yours. So lots of benefits there. But, I will say, though, we do have a lot of clients who come to us from either other managers or clients who have maybe tried to manage their own bond portfolios. And there are some downsides from trying to do it yourself. Because the bond world can be pretty complex. There are a lot of little bells and whistles, if you will, on some bonds, things like call features or extraordinary redemption provisions. These are things that allow the issuer to pay that bond off early. There are some other features that can limit their liquidity. So just kind of strange features like sinking funds, and there's lots of little nuances that as an individual investor, you might not know about just because you don't have access to the information. We have lots of different data sources, Bloomberg and all these other things, where we can look at every bond before we buy it and make sure it doesn't have any little unattractive features that we don't like that's going to make it kind of hard to sell. As an individual investor, you might not, have access to that information, and you can, there'll be pitfalls there if you bought something and you didn't really understand all the features. So we always caution people, if they want to try to do it yourself on bonds, to just make sure that they are educated about everything. They do have access to all that information. But the
Monica,
reason,
before you switch slides over on that, you guys, this is a really important piece that she was just barely talking about. This is how the rich get richer, and it's something that's been important to us also. So you heard her talk about the minimum is 250,000. Typically, the only way people could go buy these bonds directly, they had to have millions of dollars. It usually was for like family offices and things like that to go buy these bonds directly. So we're really fortunate having this relationship with Monica and her whole team. She has a giant team where they've been able to pull it down to that $250,000 mark for our clients. So I really appreciate that with Monica being able to do that. And those pieces she's talking about, buying those bonds directly versus buying them via the mutual fund or the ETF, hands down, it's so much, it removes a lot of the risk that we're exposed to when we own them via a fund structure. When I can go buy them directly, I'm helping actually pull down some of the risks that she talked about, like interest rate risk and pieces like that. So yeah, we really appreciate that.
Absolutely. And that's, it's a kind of a good intro into, I'm just talking about what the various risks are in bonds versus stocks, which is, why would you want to own fixed income over stocks, right? Well, it's not necessarily an either or decision. It's an either and decision. for most people, almost, and I won't say everybody, I always hate to use, these terms, everybody and always, but almost every portfolio needs to have some fixed income, right, in some format. You wouldn't want to be 100% in stocks in very many circumstances, I would think, just because that's a lot of volatility. The equity market's going to have a fairly high volatility. If you've been in it this year, you probably know that. The drawdowns there, although they haven't been actually that big compared to some of the bigger drawdowns like the '08 financial crisis and some of those bigger events, they've been a little bit painful, and it's been one of those years it's been a little bit difficult, but there's always going to be that volatility in equities, right? And then if you say, I don't want that volatility, I don't want to be in equities, well, you're also not going to get those higher returns over the long term. They will have the higher returns, but you do have to be able to stomach that volatility. So most portfolios, though, are going to want to have some of each, because you want to have the equities to give you longer term growth potential, but you want to have some fixed income to give you stability, which is basically, not having as much of the up and down that you get in the stock market. There will be up and down. It's not that there isn't movement in fixed income. If you have bonds in your portfolio, you'll see the value of them go up or down a little, but by and large, they just don't tend to go up and down by as much as the equity market. Now, one of the misnomers, I think, or myths, if you will, about the fixed income market is that it will always move inversely to stocks, or it will move, against where the stocks are going. And that's not necessarily true. It will tend to be true a lot of the time, but not all the time. And this year was one of those unusual times when actually stocks and bonds all went down. But that's not the typical case. Usually they will be inverse, but the fixed income overall will just have smaller movements. So that's why I like to call them the shock absorber of your portfolio. And how much of it you need in your portfolio, it really depends, both on what is it there for. Is it just income, or is it just that price volatility damper, if you will, or is there some particular funding need? So, we like to look at, what is the investor going for here? Are they just trying to provide some predictable, dependable income source for a specific need, like retirement income, or maybe
Monica,
mm-hmm.
let me speak to it, just so you have an idea, because we've really invited mostly just my clients on this. We haven't opened it up to a lot of people that aren't clients on this webinar. So like our approach that we've taken in wealth management CPAs is we always want to make sure between people's income, so like their Social Security, pensions, things like that, their bank account, and then we usually use the bonds, that they have enough money to cover them for the next 10 years. So that way, kind of exactly what you're talking about, that shock absorber ends up being there, so that our equities positions, when it does experience like what we're experiencing this year, a big drawdown, that we have a 10-year window to be able to ride that out. And then that's the other reason why we like buying those bonds directly, is so that in a year like this, where we're watching the stock market drop, but we're also watching the Fed raise interest rates, which in turn pulls down the fair market value of our bonds. But we bought those bonds directly, so we can just hold them to that maturity date. And so our clients aren't really subject to that interest rate risk on that side. Just so you kind of have an idea of how our approach, how we're typically structuring these portfolios.
Exactly. Yeah, and that's a great way to look at it, because that aspect of having that maturity date does give you that protection, I think, both from the liquidity risk, the interest rate risk. You're not so much worried about that price volatility. Some people, though, are looking at their fixed income exposure as just sort of a generic fixed income exposure, if you will. Again, you've heard of 60-40 portfolios. Well, the 60% stock, 40% bonds, and that's just to give them some protection from the volatility of the stock market, but maybe they're not looking at it as a fixed need in terms of the income or the maturity. So there's different, ways that people look at what they want their fixed income to do for them. But either way, the bonds, as we said, when you have enough to do a well-structured portfolio, it's typically better to have those individual bonds than to have the funds. So let's just talk about real quick a couple of more just real basic stuff about bonds and how they operate, if you will. Again, stocks, when you talk about mechanics of stocks, it's fairly easy. I mean, obviously they can go up or down, and the movements can be scary. But at the core, you're just owning a piece of this company. Maybe you'll get a little bit of a dividend, but you're mostly just betting on, the price going up or down. So the mechanics are pretty easy, and you can look on a screen, anywhere, Yahoo Finance or whatever, and see what is this stock trading at, and about what it's worth. But bonds are different, really, in the way that they trade, the way they operate. So again, you have that semi-annual coupon payment. And generally it pays every 6 months, whatever half of the total annual interest in. So you can take your coupon times your par amount, divide it by 2, and that's your semi-annual payment. But the coupon payment generally is set for the life of the bond. Now there are floating rates. Again, we don't see a lot of those, but this is why we call it fixed income, because what that coupon payment is going to be for the life. Now, since that coupon is fixed, though, if you think about it, obviously the rates that we see in the market, or the rates that the market is demanding for different types of bonds, is changing all the time. Like just again today, we just said in breaking news, the Fed announced they're raising the Fed funds rate by 75 basis points, which we pretty much expected, and that was largely priced into the market. Strangely, we actually have just a little bit of a tick down on some of the lower rates on the longer end of the curve, and a lot of reasons for that we could talk about later. But but generally the movement, you're going to have movement in rates, and so that's going to control what rate that the market's going to demand for this particular bond. And if you buy a bond today, you probably have to pay either a little less than par amount or a little more, so either a discount or a premium, just to allow for that difference in what the actual stated coupon is versus what the market is saying it's worth. And so the difference is that premium or discount, and that will go up or down with where rates go. But it's an inverse relationship, right? So if the yield that the market's demanding goes up for a particular bond, the price has to come down to compensate for that. So that's the inverse relationship. Another thing that's real important to consider that I think a lot of people don't realize on bonds, you always get every day of interest that you're entitled to. Every day that you own that bond, you get a day's worth of interest. There are no penalties. If you go to a bank and you get a CD, that's not a negotiable instrument. In other words, you can't necessarily go sell that to somebody. You can go cash it in, but the bank's going to probably charge you somewhere up to 6 months worth of interest as a penalty. With bonds, you never have that. You basically, when you sell a bond, the person who is buying it from you has to pay you your accrued interest up to the day that you're selling it, from whatever that last coupon payment was. So remember, the coupons are only every 6 months. The people who pay out those payments don't prorate it for how long you owned it. If you own it on the day of the coupon payment, you get the whole thing. So so the opposite works if you're buying a bond. Again, if it's in between those coupon payment dates, you have to pay that previous owner for their amount of that coupon, but then you're going to collect the full coupon on the next payment day. So you always get paid back for that. But it's something that a lot of people don't realize. When you buy a bond, you do have to add in that accrued interest to the amount of money that you're putting in. Now, important though to remember, you're not going to see that accrued interest on your account statement. So when you log in the next day after you buy a bond into your account, the custodian is not going to show you that accrued interest. They're only going to show you the market value of the bond. So you always have to remember, oh, but there's some accrued interest out there. So you really don't see the full value of that bond. Because again, if you turned around and sold it, you'd get paid that accrued interest. I won't spend a whole lot of time on tips. I'm going
to just emphasize, put an exclamation point on what you're just barely talking about, just because I know that's a really important piece. Sometimes when clients it's their first time going into bonds and buying these, we go in, we go buy them, and then we see that drop in value. And that's because you have that accrued interest, just kind of emphasizing what Monica was just barely talking about. So if we went and sold it, then you actually would get it for, since the last one all the way to that full period, because you paid off the previous bondholder.
Exactly.
So sometimes people are just concerned, like, wait a second, I just bought these bonds and then they just dropped. Not necessarily.
Yeah, absolutely. And yeah, again, just to stress, you get every day that you own the bond, you get paid your interest. So there's never a penalty there. Yeah.
Yes.
So again, I won't spend a lot of time on tips. I just know there's often a lot of question about treasury inflation, especially starting about 6 months ago when, you know, inflation really started to blow up. Everybody was wanting to know about tips and why you should or shouldn't buy them. The treasury inflation protected securities, or TIPS, are just a type of a treasury bond. But they have this component for inflation built into them. And they can be pretty complicated. The way that it works is that you do get a coupon on that bond, but both the coupon and the par amount of the security are then indexed for inflation. So let's say, you know, if the CPI index goes up by, you know, 5%, 6%, whatever it is, then they sort of index or, you know, up your par amount and your coupon to allow for that inflation over time. And that adjustment happens, I think, every 6 months on the coupon period. So whatever the previous 6 months inflation was, it's going to get built into that. And so at the end of the day, when you get paid at maturity, you will have a larger amount than par that's going to be paid to you to compensate for the inflation over that period of time. You don't get any of that, though, until the maturity. But the downside is you do have to you do have to pay taxes on each indexed amount at the coupon date, even though you didn't get the money. So that's kind of a downside of actually owning the bonds themselves. If you own it within a mutual fund, you don't necessarily have that. You will get some capital gains adjustments within the fund, but you just won't have to worry about that specific inflation calculation, if you will. So, the pros, though, of owning TIPS is obviously it will keep up with inflation. You will get a return that will match inflation, but the problem is it won't be any more than that. So, you know, in periods when inflation is pretty high, like the last 6 months, yes, you'll have a good return, but it's going to go down whenever inflation goes down. And over time, you're not necessarily going to beat inflation. You're just going to kind of match it. And also, you can have losses in them, just like any bonds. If rates go up a lot, the value will go down, and you can have a decrease in the market value of that. So again, it's one of those myths I think sometimes I run into is people think that the value of these can't go down, and it absolutely can. So for the tax reasons, though, and because they don't necessarily offer you more return than inflation, we don't always recommend them a lot. We find that you're really better off in other instruments if you're really just worried about inflation over a longer period of time. Again, we just talked about, you know, Rob mentioned a lot of people look at their statements at the day after they buy bonds and say, why does it look like the value of my bonds went down? The biggest reason is accrued interest. Again, that's just, it is money sitting out there that you're going to get. It's just not on your statement. Sometimes I like to tell people, think of it sort of like a piggy bank that's out there. That's it's your money and you're going to get it, but it's just not showing on your statement. The one other thing, though, that can account for some of that apparent decrease, although it's really just a paper thing, if you will, kind of similar to the day-to-day price movements, is just what's called bid-ask spreads. And this just gets into how bonds and stocks are different in terms of how they trade. The bond trading world is still actually very I don't know if I say prehistoric, but it's not entirely electronic. Sometimes it looks like it's electronic, but it's really still a dealer to dealer market. It's not like the exchange pricing that you see on stocks. Dealers basically put out offers or bids to buy something, and they agree on a price, and then they may execute the transaction in some electronic transport. But at the core of it, it's two dealers deciding, how much is this bond worth and what am I going to pay for it. So, and dealers obviously do that to make a profit. So they're going to sell you a bond at the ask price, which is the higher price. And then if you want to turn around and sell it back to them in a very short period of time, then you're only going to get the bid price or the lower price. So, the spread there is the profit that they make. Now, we don't make that profit. We're not dealers. We're just strictly going out and finding the best bonds that we can for you on your behalf. But when the dealers start, selling bonds, then they're putting that bid ask spread in there. So, long-winded way though, just to say, when you see the value of the bonds on your statement, it's going to be priced at the bid price, because the custodian's going to say, this is what we think you could sell it for. So there would seem to be a little bit of a loss there. It's pretty small, but also it's if you're going to hold it to maturity, again, this is one of the beauties of holding bonds to maturity, is all that won't matter, because the difference in the price that you pay and what the par amount that you get at maturity, that's part of your return, but that's fixed, and you know what the coupon is going to be. So all of those, the bid ask spread, the market price changes in the interim, are really not going to affect you. They're not going to affect the return that you're going to get.
What if a bond gets called?
So a call feature is what gives an issuer the ability to prepay that bond early, if you will. Generally, if there is a call feature, it has to be set out in the indenture of the bond, so we know about it when we're buying a bond. A bond's either callable or it's not callable. If it is callable, it's typically callable only on certain dates, maybe just one date, but maybe any coupon date, or there's lots of permutations, but we know exactly when it's going to be callable, and if they can call it at either par or if they have to pay you a premium to call. Those are all possibilities, but we're always evaluating that when we're buying bonds, because let's say if you buy a bond at a premium of 102, 2% over the par amount, and then it gets called at par, well, you've kind of lost 2%, right? And if that happened in a very short period of time and you weren't expecting that and you didn't price it in, that could be, a pretty bad loss. So we make sure when we're buying bonds, if it is callable, what price is it callable at? What would be the worst return or the worst yield over the term if they were to call it early? And we just make sure that we're not getting into a situation where that yield would be really low or even negative. We absolutely don't want that, but we just want to make sure you're not going to be hurt in terms of your longer term yield just because that bond got called. But that's one of those kind of really complicated things, I think, sometimes that can trip up people that are trying to go buy bonds on their own if they don't know how to evaluate that, or even how to see whether it is callable or not.
Thanks, Monica.
Okay. So just real quickly, I'll also run through some of the different things that, when we're buying bonds, that we want to make sure to look at and evaluate carefully is credit quality, obviously, because, the big thing about buying a bond is, you want to make sure you're going to get paid back at maturity. That's part of your return, more so even probably than the coupon. And how we determine the likelihood of getting paid back is that credit quality, we call it, which sometimes is captured in the ratings. You've heard of Moody's and S&P ratings, and those are important. We don't rely on those entirely, but part of the credit quality is really just the what type of bond it is, who the issuer is. So the very highest credit quality obviously is the federal government, the treasuries, agencies, which are also guaranteed by the federal government, agency mortgage backs are guaranteed, investment grade municipals. So these would be things like the states, the local governments, counties, cities, school districts. Those are seen as, while not quite as good as the Treasury, they're very good, and they're probably better than anything else out there. CDs, which, obviously FDIC guaranteed. Oh, and one other thing I'll point out here, that on CDs, I mentioned when you go to the bank and you get a CD, if you want to cash that in, you're going to get that penalty. But there are CDs actually out there in the market that you can buy and sell just like bonds. They price a lot like bonds. They actually have the same accrued interest features. So if you go and buy one of these CDs in the secondary market, and we do these for some of our bond portfolios, sometimes if that's the best yield in a certain short maturity that somebody wants, then we'll buy that because it would be FDIC insured, so it's very good credit quality. And again, you have that accrued interest feature where if you sell it, you get paid every day of accrued interest, and you don't have those penalties. So just want to mention that that's a little bit different than when you just go down and get one at the bank. But in that sort of mid-level credit quality sector, things like investment grade corporate. So these would be your big corporations, very well rated, BAA and up. Things like, you know, Apple and Target and Microsoft and a lot of these bigger corporations. Some of what we call high yield municipals, which are still municipals, but they're a little lower rated than those investment grade municipals. It might be municipals that for some reason, or maybe there's a little bit of a distress in them, or they're just not seen as the best financial managers, if you will. So, and I hate to pick on anybody, but I'll just mention states like Illinois and New York and New Jersey that are traditionally just not the best credit quality. Those will tend to trade in that high yield sector, whereas somebody like a state of Utah, who is very well regarded in terms of financial management, those will trade at much lower yields because they're just seen as better quality. And then in that lower quality area, you've probably heard of high yield corporates or junk bonds. That's sort of sometimes synonymous, but that's basically just anything that's not investment grade. So double Bs and below. So we do in one of our bond strategies, which we call enhanced income, we'll do some of the things in this category, but not all of them. We don't do the really speculative C rated and below. We only do B to double B, and we're really, really picky about the companies. So we look at their balance sheets. Again, we don't just look at Moody's or S&P ratings. We actually go in and look at these companies, follow their earnings, look at their business models, and revisit them periodically to make sure we're still, comfortable with them. So some of the ones that we'll do in this space, they're not necessarily troubled per se, but they just might be smaller than the typical company that might fall into investment grade. So they're not going to get that kind of higher rating, or maybe they have, more debt on their balance sheet than a Moody's or an S&P would allow in terms of having that investment grade rating. But again, we still think they're good companies. They have good business models and good earnings. And, we monitor those obviously from time to time. So there's this whole spectrum of credit quality when you go from, the highest to the lowest. And as you'd expect, though, as you get into the higher credit qualities, you also have less yield. That's just one of those risk return things in the market that always applies. The less risk you have with something, the less yield or the less income that you're going to have. So again, just reviewing just some of the types of bonds that we'll see in the market. Treasuries, obviously the highest rated credit quality, the gold standard. Agencies, just a tiny bit below that, but still guaranteed by the government. Corporates, the bigger ones like the investment grade, the Apples, the Targets, the Home Depots, those guys will be in that higher rung, and then other companies may be in a lower rung, but they're still all considered corporates. Municipals, which would be, again, municipalities like states and counties. One thing I'll mention here in municipal land, another kind of pitfall I find with people who try to maybe do it yourself on the bond portfolios, if they're not really versed in municipals, this can be an area where there's lots and lots of little nuances and nooks and crannies that can get people into trouble. There are bonds that trade in the municipal world that are they're considered municipals, but I think they're sort of quasi-municipals because, for instance, you can have a bond that's based off of a leasing entity that leases some type of equipment, like maybe a fire truck to a fire department. And that particular leasing entity, while it does get municipal and tax exempt status, is not really a municipality in that it doesn't have any taxing authority. It's not really the fire department. It's not really the county. And the reason these are done is sometimes to get around debt covenant issues, like maybe the fire department can't issue new debt because they have too much. So but they need a fire truck. So instead of just borrowing to buy the fire truck, they have a leasing entity do it, and the leasing entity gets the bond. So it gets really complicated, like I said, but if you don't know how to look at that and pick that out, you might not realize that that particular bond is going to be a lot less liquid than if you just bought a bond of that county or that fire department even. So just lots of things you can get in trouble with there, that we avoid. We don't do any of the less liquid structures. We don't do any of the distressed credits or anything like that. And I'll just mention real quickly a couple of other bond types that we have people ask about them from time to time, but they're probably not things that you would utilize a lot in your portfolios. Savings bonds, we've actually gotten lots of questions about the I bonds, the inflation bonds lately. All of the savings bonds, these are things that are issued directly through the Treasury. So you have to, as an individual, go to the Treasury, send them your money and tell them what you want them to buy. But they're not things that are negotiable. So you can't go sell it. We can't sell it for you. We can't hold it for you. And you can only buy these in very limited quantities. For instance, the I bonds, I believe the limit's 10,000 per person, maybe 20,000 per couple. So it's something you could use in fairly limited quantities, if maybe just for like child education or something like that. But it's not going to be a big meaningful part of most people's bond portfolios. Yankees and euros are just different ways that corporations that are either foreign corporations, but they want to issue U.S. bonds, they call these Yankees. If it's a foreign corporation issuing bonds in a foreign currency, that's a euro. We don't really deal in these bonds. You may never see them, but just to know it's kind of a way to buy foreign bonds, but sometimes without having to worry about the foreign currency. CDs, again, there's different types of CDs. You can go to a bank and get them, or you can buy them in the secondary market and get the benefit, again, of that accrued interest feature. So that's just a quick overview of kind of the basics of bonds. Any questions, Rob, that we have on?
We have had some questions for you. So let's ask these real quick. And maybe you're going to talk about this in this next section. I don't know, but the rates that you're seeing with the different types of bonds. Do you already have a slide for that?
You know what? I don't have a slide, but I could give you just a quick rundown of, so on the investment grade corporates that we talked about, we do portfolios of those that are between 3 and 7 year kind of bond ladders, and we're seeing about 6% on that. On the, I mentioned EIP, or enhanced income, and that's the B to double B corporates, non-investment grade, but not, what I would call junk. We're seeing about 8% there. Well, actually about 790. It's dropped just a tiny bit, about 790. And then on municipals, we are seeing about, so I'm gonna pull up a number real quick. Let's say for a Utah client, excuse me, there's actually several states that we can buy bonds from Utah and have them exempt from state tax. We don't have to do just Utah. If we do just Utah, the yields will be lower. I'll tell you, I actually had this question earlier. But
that's a good point that she's talking about. So like we can, for people that live here in Utah, we can go buy bonds down in like Florida, or Texas, and states where they don't have a state income tax, and we'll recognize that here in Utah.
Right. And when we do a Utah tax exempt portfolio, it tends to be more of those. It tends to be a lot of Texas, Florida, just because that's where a lot of the bonds are, a lot of the good bonds with the good yields. It might have a few Utah, but that mixture, about 423 right now, which if you're in the top tax bracket, that would be equivalent to getting about 746 on a taxable portfolio. So, and I
That's
mentioned
a
the
big
investment
deal.
grade. Yeah, I
Right.
mentioned the investment grade corporates only were off, I say only, but they're offering 6%. So that's a lot less than the equivalent in the muni portfolio. So that's why right now I think munis are a great value. But just to give you an idea, if you really just wanted Utah, that yield drops to about 370. Well, big difference
That
from
is a big difference.
423 to 370. Yeah, just because again, Utah is a very well regarded state in terms of financial management, and so their yields are going to be lower than a lot of the other.
What about California? I have clients in California.
Yeah, actually, California usually tends to be really close to what we would see on the Muni Utah or the national one. But right now it's a little bit lower. I'm seeing only about 365 versus 428. And it's really, I think it just all of a sudden changed. And really, I think it's just because, California announced recently that they're going to be raising their top tax rate again to 11.3. And so this is
As a CPA,
obviously,
that drives me nuts.
yeah, I don't understand it, but so this has obviously created a lot of demand, and whenever you have a lot of demand for anything in the muni world, then the yields go down, and that's I think what happened. Now, whether it'll stick that way, I don't know. Sometimes these things tend to bounce back. It's just the result of just a quick, increase in demand, and sometimes it'll bounce back. But right now, yeah, those are much lower. But even at 363, that's a 667 taxable equivalent for a California. So it's still better than the investment grade corporate, but it's just not as good as some of the others.
Another question we did have, when we're talking about taxes real quick, is how do RMDs fit with bonds? And the bonds is a financial vehicle, and the RMDs, that's because of the tax classification. So RMDs are going to work similar, whether it's with bonds or stocks or an insurance product or anything else like that.
Yeah.
It'll operate it'll operate the same.
Yeah, exactly.
It's not
RMD
being over with bonds. One thing I can tell you though is we don't want to, and it's funny because I see people come through the firm that have had other advisors, and I start dissecting their portfolio, and I'll see IRAs that own muni bonds.
okay.
And I'm like, was there some thought there, or did the advisor just make a mistake? Because I'm not getting the tax benefit of the muni bond, which is why I typically go over to that when I have it in an IRA, because it's still all going to be taxable. So
exactly. Yeah, I've seen that actually too. And sometimes I just go like, ooh, who did that?
I know.
But yeah, you wouldn't want to give up that tax exemption versus just doing taxable bonds, because at the end of the day, you have less money. I mean, that's really what we look at, is not just what yield you're getting, but at the end of the day, where do you have the most money left over, right? So yeah, we always want to look at that. And so it would tend to be that in an IRA or any other tax exempt account, you generally wouldn't want tax exempt munis, right? But also just in the type of tax exempts, like I've seen some people, particularly a state like Idaho, let's say Idaho, yeah, there's a state tax, and you could get a state tax benefit if you buy in-state, but there's so few. There's just very, very few Idaho bonds out there, very few issuers and very few available on the market, that I could go buy them, but the yield would be so low that it wouldn't be worth the state tax exemption. You'd actually be giving up even a lot more money even after that state tax exemption. So you'd be much better off just going to buy, across the nation or, other states. So yeah, we often see a lot of that too, where someone they weren't really thinking through that, right? They just say, oh, it's Idaho, I have to buy Idaho. But you really have to kind of know the nuances again of the different states. Supply demand is just very different in every state.
Good job.
Thanks. So I think we just have a couple minutes left. I'll quickly go through again. I sort of talked about these things already about why, why wouldn't you want to do your own bond portfolio? Why would you want to use a manager? And, obviously access to all this information, that we talked about in terms of the different nuances in the bonds, the features of them that make them either more or less risky or more or less liquid. You want to, make sure to know about. And it's really hard to get access to that information, if you don't have some of the things like a Bloomberg that we have, and some of these very expensive information and data tools. But and also just having that vision of just this thing that we were talking about right now about municipals. And this comes from the fact that I'm in the market every day, and I'm looking and I'm seeing what's out there and where it's offered, and these things change day to day. Just because there's not a lot of Idaho bonds today, it doesn't mean there couldn't be, in a few months. I kind of doubt it, but but they do change. Things often do in the market change from time to time. But also just having the discipline again of the management. Like, we're very disciplined not only about our credit selection, about how we structure the portfolios to give you protection from rate volatility and so forth. We do this laddered maturity approach, which, if you have actual maturities in your bonds and you've got some shorter ones and some intermediate and some longer ones, then you always have something that's more liquid. The shorter ones are more liquid because you don't have as much price volatility. You always have that sort of built-in liquidity. Bonds are always rolling down the curve, we call it, as they're getting shorter and shorter and closer to maturity. You're lessening your rate risk, and you're reinvesting at higher rates as you roll them back out to the end of your ladder. So all of those things, managing the laddered maturity approach, the credit analysis, customizing the maturity schedules, as Rob mentioned, for his clients, he's looking at the maturity schedules and the cash flow in a very disciplined way around, how much income you're going to need for different things. And so all of those things, it's difficult for someone, if you're not versed in bonds and you don't have access to all the information, to really put that together. So, the laddered maturity approach, again, is just something that we think is the best approach for most individual investors, because you want this to provide you income, but you also want it to provide you that stability and that lower volatility, and that laddered approach will give you both of those things, very predictable income. But it's all about the discipline, though, of keeping your ladder well structured and making sure you're reinvesting. Diversifying, one of the principles of how we manage, again, we want to spread your risk across different credits and different types of bonds. And one of the reasons we do have it's a lower minimum, but it is a minimum on the bonds, because it's set specifically to provide to make sure that we have enough different names in the portfolio to give you that diversity, to give you the liquidity, and that you don't have just a bunch of bonds in a portfolio. It's something that it makes sense in terms of both its maturity and the risk profile. So I won't spend a lot of time on that. Again, we talked about interest rate risk. The longer the bond is, the more rate risk or price volatility you have. So that's why you want to have that ladder, with the shorter maturities. The prices of the bonds move inversely, with the market rates. And so that's really about it. I'm just showing here the yield curve. Again, a kind of more current yield curve. We got word from the Fed again that they are raising rates by 75 basis points. We pretty much thought that would happen. And actually what's going on right now is we're getting just a little bit of a bump up on the short-term rates and a little bit of a decrease in the longer-term rates, which is giving us a little more of that inversion in the curve. Actually, Rob and I were talking about this earlier. It's something that tends to be surprising, I think, to people who don't look at rates every day. When the shorter rates are actually higher than the longer term rates, it looks funny, but it does happen from time to time. It just basically means that people are looking for a recession, at some point next year. And so they're putting those longer term rates lower because they think rates are going to drop at some point, when and if we do get that recession. So that's all an inverted curve means. Yeah. So I think I've kind of gotten to the end of the slides, and we're coming up on the hour. Do we have any other questions, Rob?
Monica, you are so good. We just appreciate you so much. So here's another question. If I own the bonds directly and the Fed raises rates and I start seeing rates go up, do I welcome that, or does that make me really nervous?
It's good news, bad news. Always, I say, when you see rates going up, obviously, if you already own bonds, it is going to mean a little bit of a decrease in the price of the bonds that you own because the market's demanding a little bit more interest. So your bonds are worth a little bit less. But again, if we've structured that portfolio well, it's going to impact the shorter maturities by a very small amount, maybe a little bit more on the longer maturities, but overall it shouldn't be a huge difference. But also it's good news in that as those bonds are rolling down and we're reinvesting, we're getting higher rates. So we're actually pulling up the yield on our portfolio. So yeah, it's a little bit of a good news, bad news. But again, the beauty of that ladder portfolio is even the ones, say, on the longer end of your ladder where you've had a decrease in the price volatility, we're going to get paid at maturity. We're going to get paid at par. I mean, we've already built that in, right? And you're still going to get the same yield that we determined at the time we purchased the bonds.
Yeah, I can't emphasize that enough, like how appreciative we are that we have this relationship where we can go buy the bonds directly, because when they do raise the rates, and as long as I just hold those bonds to maturity, I really can just kind of shrug my shoulders. It's like, it doesn't make a difference for me, But if I held them via a bond fund, then yes, I'd be like, oh, great. It'd be driving me nuts, the announcement that came out today, so. Yeah. Can we get a copy of your slides, Monica?
Oh, absolutely.
Okay. Yep. We can send those out to everybody. What about, okay, good question about the cash management. Do you want to speak to that?
Yeah, actually, thank you for mentioning that. I kind of forgot as I was talking about some of the other yields. I forgot to mention one of the big changes really in the last couple of months is that what we've actually renamed that product, it's called 3P short duration. We used to call it cash management because it was kind of a quasi money market substitute, if you will, just really short bonds. We typically do like 1 to 3 year bonds, and sometimes we can do even shorter if you need to, but what that 1 to 3 year short maturity structure gives you is just obviously a lot less volatility, but something that can kind of provide for just a parking place, if you will, for really short-term funds. You're not really sure, when you're going to need them. Before, about a couple of months ago, there was hardly any yield on those types of things. I think it was way less than 2%. Right now on those, again, 1 to 3 year, we're getting about 5%. So yeah, compared to, again, the longer 3 to 7 year corporate ladders are at 6, so they are higher. But that difference, I call it the give up, if you will, for staying really short at only 100 basis points is not a whole lot really right now when you compare to what it was historically. I mean, you almost had to have no yield before to be able to stay that short. So yeah, this has been really, really attractive for a lot of people. In fact, I'd say most of the inflows, the new money that we have coming into these products, it's almost all going into either the short duration or municipals, because that's just where the really attractive yields are. But yeah, that's been a big change. And it's really just all about the fact the Fed is tightening right now, and there's a bit of uncertainty as to how much and how far they're going to go. And anytime there's uncertainty like that, that's you're going to see those short end yields go up. But again, the longer end of the curve, it's still lower. We've got that inversion, and again, that's just telling us that at some point the Fed has to stop tightening, and if they kill the economy and we go into recession, then they're going to have to start lowering rates. Now that might not be till later next year. I mean, who knows when that's going to happen, but at some point it probably will happen, and that's what the inversion is telling us.
Yes. Yep. It's going to have to, it has to happen eventually. Part of it, I just watching the economy. It goes through these cycles always. And that's what we're doing. We're just going through a pretty big swing right now. So, yep. And part of it, I mean, the Fed's dropped rates literally to 0 just 2 years ago. So
Yeah, we've been in such a period of really, really low rates for so long that there's so many people out there in the market, the younger folks, not me, but that have never seen an environment of high rates. And I got into the markets right after the Volcker years when rates were still pretty high. To me, that was normal. And for the longest time, as we've been in this really ultra low rate environment, I've just continually marveled at, my goodness, how much lower can they go and how long can they stay there? And obviously they can't stay there forever, but they also can't keep going up forever either. It is, as you mentioned, it's a cycle. It's going to cycle up and down. And yeah, just try. It's difficult to try to pick, what those inflection points are going to be. No, I don't think I could do it any better than anybody else. So, we typically just tell people, if the rates look good, they look attractive, just be invested, and use that ladder then to help you adjust as time goes by, because you're always reinvesting at whatever the current rates are.
Yep. Yeah. And there's been study after study talking about that. Just own something rather than just sitting on your hands always. I know right now it's difficult this year, especially because we're watching it where the Fed has raised rates so dramatically, to nearly 4% just this year. If you can look for a silver lining in something though, really almost the last, I'd say like 14 years, our borrowers have been penalized and our borrowers have been rewarded and our savers have been penalized, where finally that shift is occurring where our borrowers are being penalized and our savers can finally get some sort of reward, so try to find the silver lining in everything and try and navigate it. So anything else, Monica?
No, I think we've covered a lot. Again, thanks so much.
You're wonderful. We appreciate you so much. So, well, if you guys have any other questions, feel free, reach out, give us a call, 801 CPA help, 801-272-4357. Send us an email. And we just appreciate everybody so much. So thank you, Monica.
Thank you.
Okay.
Bye.
See you. Bye.